companies listed on the QB. 2,300 of them are SEC reporting companies, and 650 are banks, 300 are shells, 150 foreign companies. The highest level, called OTCDX, and that's the bulletin board proper. And in that one, a market maker has to act as a sponsor for the stock to be listed there. Companies on the OTC have to make full disclosure with the SEC, meet higher financial standards, and include such securities as warrants, American depository receipts, direct participation programs. There's a lot of different complicated instruments that they use. There's 350 listed companies on that exchange, representing 1.5 trillion in market capitalization, with an average of 1.8 billion trading volume. The very similar service offered by FINRA, the OTCBB, under Rule 15C 211, the SEC allows non-reporting public companies to be quoted on the FINRA bulletin board with a simple disclosure form. But there's not that much trading on it, and that's why people use the other exchange. With the SEC, like the S1 registration statement, which requires a company to file a report for a year. You also might file Form 10 or Form 1012G and thus become a reporting company under the rules of the Securities Exchange Act of '34. And to be eligible for the quotation of your stock, a company has to find a market maker that will, and this is the important one, this is the form you want to remember. It's called Form 211. And this is the form that the market maker files with the SEC. And that is what makes you an actual public company. Companies have to have enough stock in their float, in other words, what's available for sale to the public. You've got to have enough in there to be tradable, and there's different requirements on that. The company has to be fully reporting with the USC, have a minimum of 40 stockholders, holding a minimum of 100 shares each, and you must have a market maker submit Form 211 and agree to act as the market maker for the company's securities, which means that they stand ready to buy and sell at any time. That's the important feature of a market maker. It's not easy to find them. If you have a shareholder base of people who have acquired your stock privately, and here we're talking a few dozen at least, you're eligible under the Securities Exchange Act of '34 to list on NASDAQ's OTC bulletin board. There's a lot of advantages to a listing of this type, including an increased liquidity of company shares for owners, a higher share price, and a higher company valuation, in addition to greater access to the capital markets and the ability to use shares as incentives to attract better employees and to acquire other companies using your stock as a kind of instrument or asset. And it's also good as a harvest or exit strategy for owners, a way to cash out and get out of the business. However, IPOs can be difficult for many reasons, including problems finding a market maker, and depending on what level of OTC market you're shooting for, it can be costly, time-consuming, demand a lot of attention from management and owners, and require a history of earnings and profits and various levels of regulatory paperwork and disclosure. Now, there is a way around this called the reverse merger. There are a few companies that specialize in this, including GoPublicUSA.com, TaurusFP.com, GoPublicShellsReverseMergers.com. We're going to take a look at one of the websites of one of these companies. This is reversemergers.net, and they really do offer some very, very good information about how you can take a company and go through a reverse merger. We are going to discuss that right now. You simply buy a shell company that's already been listed with one of the exchanges. And it's fairly simple. A private company merges with the public company, and the company simply continues as the dominant successor entity. You can even change the name to your own company's name. These listed companies are referred to as blank check companies or as public shells. It was a way to go public quickly and at low cost. And depending on your cash flow, if you have sufficient money, this was for many years an alternative route to gain access to the capital markets. Unfortunately, the SEC has taken a violent dislike to reverse mergers because of so many scam artists using them. And it has put so many restraints on the purchase of shell companies that honestly, you might as well just give in and file a 34 Act Form or a 10, the equivalent of registering as if to seek to list with an OTC bulletin board. A similar strategy is called the registered spin-off, in which a private company goes public by issuing shares of their stock to an existing company. And this is also called a registered stock dividend distribution. For those companies or people that are interested in this, it's pretty complicated, and you're best off doing some research and discussing this with an attorney. But the basic result is that there's two companies that share a public shareholder base. And once this occurs, the spin-off company then finds a market maker and lists independently. And typically only a small percentage of shares is listed in the spin-off, and for a very low cost, it prepares the company for an IPO later. This is so-called Form S-8 stock, which can be issued. And the only real barrier is that existing shareholders have to agree, and you have to accept the fact that financial markets now hold the company's future in return for a higher market value. The other alternative mentioned earlier is the DPO. The DPO is not much different than crowdfunding. For those interested, I advise you to see the section on alternative finance on my website, which the address is down at the bottom of your screen. And I have articles on there on crowdfunding, which is really the essence of DPOs. Nonetheless, I have some interesting and unique information for you this evening. Those interested in DPOs might want to check out the Startup Stock Exchange, and we're going to take a look right now and take a look at their website. There we go. There's the Startup Stock Exchange homepage. And this was established by a company called AngelList. And the SSX is actually a part of a platform for startups. And it's related to the Dutch Caribbean Securities Exchange, operating out of Curaçao in the Netherlands Antilles. 11,000 companies are registered with these entities. And the due diligence, the background and documents checking performed financial institutions prior to okaying any investments in a company performed by SSX gives a good general idea of what's required from a startup to successfully issue a DPO. So for those that are interested and willing to go through the process of really seeking public money, this is probably your best bet. Startups.com is one site that is very, very useful, and also SSX, which is the Startup Stock Exchange. Basically, the way it begins, you start by submitting an executive summary of your company, the first part of a business plan, and a $25 fee. If the company is accepted by the people that run the SSX, then it goes into the next round. You submit a full business plan, and you pay a fee of $500. It's well worthwhile. The stock exchange helps hone the business plan for you, and even if your company doesn't make it, you get excellent advice and an idea of what's necessary for the company to attract investors. Once your plan is solid and the company is accepted into the next phase, SSX begins the actual corporate due diligence process, for which they charge a fee of $2,500, a fraction of what is charged by normal investment banks. After due diligence is completed, if the company is successful, you create a prospectus, you submit it to the Dutch Caribbean Exchange for approval, and if it's approved, the company pays an additional $2,500 and is allowed to go public. And thus the entire cost of the IPO through SSX, you're guided through it, and it's $5,525. Of the original applicants, few are likely to make it through the entire process, though. On average, they have a 2 to 3% acceptance rate. And once you're listed, there's a monthly charge of $1,250 covering custodial fees and fees to the regulator, which is a fraction of the millions of dollars companies pay for listing on major exchanges. Startups have to report biweekly, and investors are carefully vetted. As I mentioned, a very similar organization is run by Startups.com, which has over 20,000 investors and offers funding from $25,000 up to $1 million. It's essentially the same as other platforms like Seedrs, Seed Invest, AngelList, Golden Seeds, and equity funding, crowdfunding sites like Eureka, Zoomall, and WAMDA. And these are all places that match up investors seeking higher returns with companies that are looking for capital. Standards are set by each company. They differ, and the difficulty obtaining financing varies from company to company. So all of this is stuff that you have to take into mind and keep in mind when you're looking for capital from the public this way. My own personal opinion is that if you're not in a big rush, if you don't need capital in a big hurry, you're best off waiting for spring of 2014, because that is when the SEC is going to complete and finish the rules to make crowdfunding completely legal. And then at that point, you're able to sell your stock directly to the public. But if you need funding now, or you want to go the route where you're going to be listed on an exchange, which is really worth doing. A lot of it has to do with the kind of capital that you need access to, and just how much money it is that you have on hand. What kind of profitability your company has and a corporate value. In any case, you now have an excellent overview of how a small company or startup can gain access to the financial markets, and with persistence, a successful company can indeed tap public money, though it is not an easy or quick route to riches. I hope this was helpful to you and that your company gets the money that you need. You can find many more articles that will assist your company in getting the money you're looking for by visiting my website at the address that's at the bottom of your screen, Small Business Financing Online. And thank you for watching. I really appreciate your being here. By the way, Caroline will be on in a couple of weeks, and she will be back, and she misses all of you. Thank you very much, and you have a good evening.